Hey everyone, welcome to another episode of AdMail. This is Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everybody, Adam Bergman here, tax attorney and founder of IRA Financial. And welcome to another episode of AdMail. On today's podcast, 3 super questions on health savings accounts, or HSA, which are very misunderstood type of retirement accounts. Health savings, I call them retirement account because they act like a traditional IRA, where you get tax-deductible contributions to an HSA and the money grows without tax and takes advantage of the power of deferral, just like an IRA, but it can be used for qualified eligible medical expenses. And I wanted to do a couple podcasts on this topic because a lot of people don't realize that you can use an HSA to do alternative asset investments like real estate or cryptos or gold or private placements or hedge funds, venture capital, private equity, private business stock, private placements. There's a lot you can do. You don't just have to buy stocks and mutual funds. So I wanted to do this podcast to discuss 3 questions that I received on HSAs. But before I do that, I just want to give a quick recap on what a health savings account is. As I mentioned, it's like a traditional IRA retirement account, not widely known, very underrated, but a really good account. In order to set one up, you have to set one up at a custodian like IRA Financial or a traditional brokerage firm. The main advantages, as I mentioned, it's like a retirement account. You get a deduction like an IRA, and the money grows without tax. If you use it for qualified medical expenses, you pull the money out tax-free. Who can qualify? You need to be and have access to a high deductible health plan. That's essentially an HDHP is a plan that has higher annual deductibles than a typical health plan and a maximum limit on the sum of the annual deductible out-of-pocket medical expenses they must pay for covered expenses. In fact, most plans from small to mid-sized businesses are HDHP, so therefore you will be eligible to contribute to a HSA. How much you can contribute? If you are self-employed, just you, no family, $4,150 in 2024, family $8,300. There's also a $1,000 catch-up if you're over 55. So a family, a husband and wife can do $10,300 for 2024, and someone who's over 55 who's single, $5,150. So good amount of money. Again, it's tax deductible. The money grows without tax. What's qualified medical expenses? It's basically everything, right? We'll go through some examples and the questions, but doctor visits, medications, medical equipment, dental and vision care, kind of everything you want for your spouse and your dependents. Record keeping super easy. You basically, it's like on an honor system. If you get audited, you just need to make sure that you're not paying for your own travel or Rolex watch, but you're actually using it for qualified medical expenses. But let's get to these questions. There's 3 really good ones. First one's from Chen C. Chen wants to know, can I use my HSA to cover copays for my doctor visits? What about contacts? Yeah, I assume contacts lenses. Yeah. So let me go through and just briefly overview like some of the stuff. It's basically everything, even acupuncture, obviously over-the-counter drugs, dentures, crutches, flu shots, hospital services, infertility treatments, everything, right? Occupational therapy, physical therapy. What else is interesting? Dental and hearing, eyeglasses, contacts, braces, teeth. If you're disabled, like artificial limbs even. There's a lot along with copays, doctor office visit copays, RX copays, vision and dental copays. So yes, Jen, you can basically use this to pay for anything. The whole idea is as you're young, you want to put in as much as you can in these HSAs, let it grow without tax, invest it. And then God forbid you get sick. As you get older, you got a chunk of money that you can use without having to go out of pocket. You can use your HSA and pay for these expenses, and that money's growing without tax. So hopefully you're just using the earnings to pay for it. And if you have to go in to the principal of the HSA contributions, you do, but it's after tax, meaning you got the deduction, and then you can use those funds for any medical expenses. So you basically got the double benefit. You got a tax deduction up front, and then you got to use the funds as they grow without tax to pay for qualified expenses related to medical. So really cool stuff. Second question is from Miguel T. Miguel wants to know, I already have an HSA. Can I set up another HSA for alternative assets like cryptos, or do I need to close my other HSA and move all the funds to you? No, you can have multiple HSAs. So very short answer. Yeah, you can, just like an IRA, you can have multiple IRAs, you can have multiple HSAs. You can just open one to do alternative assets, keep your other HSAs for your traditional investments, and use those to pay for the distributions if you have to pay for qualified medical expenses, and then use the HSA with IRA Financial really to have long-term investments like private equity or venture capital, private business stocks, where you have kind of really high upside, but there's more of a holding period, and use the other accounts for your more day-to-day HSA transactions. So yes, you could have multiple HSAs, Miguel. Third and final question of today's podcast from Roland F. Roland wants to know, I have an HSA. If I die, does the HSA pass to my spouse? And the answer is yeah. That's the interesting thing. If you do die, the HSA will pass to your spouse, and then your spouse can use them and use the HSA for his or her qualified medical expenses. And then at that point, once the HSA is depleted, everyone passes, let's say, there's no more qualified medical expenses, then you can just pull it out and pay tax on what you pull out. But yes, you don't have to worry. If you have an HSA and you need to pull it out, you need to pass it on, because you pass, then your spouse can get it tax-free. You can choose a beneficiary when you set up your HSA, but when that person dies, and then the beneficiary get it, so the beneficiary can also designate a beneficiary. But if there's no designated beneficiary, there's no one left, then whoever pulls it out pays tax on it. But if the spouse is a designated beneficiary, it's basically treated as your spouse HSA after you die, just like a traditional IRA. So it really follows the traditional IRA distribution rules. The only difference is if you're paying for qualified medical expenses, when you pull it out, that distribution is tax-free. Whereas if you took a traditional IRA and took a distribution, you'd obviously pay tax on it. So with qualified medical expenses, you can use the HSA and take a distribution tax-free and use those funds to pay the qualified medical expense. The funds grow without tax, takes advantage of compounded returns, and you get a tax deduction when you make the contribution. So really, really underrated type of quasi-retirement plan. I call it a retirement plan because, again, when you get sick, you're going to have to tap into your savings to pay for your medical expenses, whether it comes from your IRA, your 401k, or just your personal savings. You got to pay for it. So why not use the HSA and allow that account to grow without tax? That is the beauty, is you get the double benefit. You get the tax deduction up front, the money grows without tax, and then you can use it to pay qualified medical expenses. But that money is growing without tax. You're going to have a lot more in the HSA than you would have if you just saved in a taxable account. So that's it for today's podcast. Hope you enjoyed it. Do a few more in the HSA. Again, super underrated. Just like a running quarterbacks, like underrated. You need it. And your employer can actually also make contributions. So I'll probably get into some of those questions about employees and employer contributions on the next podcast. So hope you enjoyed it. Thanks for listening. If you haven't subscribed yet, you can watch this podcast on YouTube if you like. You don't have to. And then obviously you know where to find us because you've been listening to this podcast. It's a weekly podcast. So I try to keep it under 7-8 minutes. Sometimes I go a little longer, sometimes a little shorter, but give you quick, succinct, detailed answers to very important questions so you can grab them and go. Thanks. Have a great day, and I'll see everyone again next week.